In this video, I want to talk about the role of diversification in reducing risk in a stock portfolio, the role of diversification in reducing risk in a stock portfolio. Diversification is a key investment strategy that involves spreading investment across various assets to reduce risk. In a stock portfolio, diversification helps mitigate the impact of poor performance from any single stock or sector, leading to a more stable returns over time. Once you are fully diversified, losses sustained in one or two sectors may not really have a large negative impact in the overall portfolio. As we consider this particular topic under a number of subheadings, number one is reduces individual stock risk. Diversification reduces individual stock risk. So in this case, we want to consider how it mitigates stock specific risk. How it mitigates stock specific risk. So investing in multiple stocks reduces the potential loss from one poorly performing sector. For example, if one company's earning disappoints, the impact is lessened if the portfolio contains stocks from other companies. It also prevents overexposure. By holding stocks from different industries and geographies, you avoid over-reliance on a single company or a single sector. Number two, it balances sector performance. Diversification balances sector performance. So it hedges against sector-specific downturn. It hedges against sector-specific downturns. So different sectors perform differently based on economic conditions. For example, technology stocks may thrive during economic growth, while consumer staples might remain steady during a recession. Diversification ensures the losses in one sector may be offset by gains in other sectors. Number three is spread geographic risk. Diversification will help you to spread geographic risk. So in this case, it gives you a global exposure. So investing in international markets can reduce risk associated with country-specific economic or political instability. For example, if a domestic market faces a downturn, you discover that foreign markets may continue to perform well. Not only that, it equally helps in currency diversification. So holding stocks in different currencies can protect against exchange rate fluctuations. Usually when exchange rate fluctuates, it will not hurt your portfolio significantly. Number four is diversification smooths out volatility. It can smooth out volatility. So in this case, there's these varied market sensitivities. So different stocks, react differently to market events. A diversified portfolio spread out these reactions, reducing overall volatility. You also want to consider how it stabilizes returns by including a mix of high risk, high reward stocks and stable, diversified, stable dividend paying stocks. You achieve more consistent performance, over time. Number five is there's that protection against unpredictable events. Protection against unpredictable events. So in this case, you discover that you need to consider economic shocks. Diversification guards against unexpected events such as regulatory changes or natural disasters, which might affect specific industries or companies adversely. Not only that, you also need to consider market trends. As market trends shift, diversified portfolios are better positioned to adopt and capitalize on new opportunities. Please subscribe to this channel and like this video if you've not done that. Number 6 is it maximizes risk adjusted returns. Diversification helps to maximize risk adjusted returns. In this case, we consider efficient frontier. Diversification helps investors achieve the optimal balance between risk and returns. Actually, so portfolios that include a variety of stocks tend to offer higher returns for the same level of risk, compared to concentrated portfolios. And not only that, we also look at how to diversify a stock portfolio. How do you diversify your stock portfolio? So in this case, you consider what is called sector diversification. Sector diversification. So you invest across multiple sectors such as technology, healthcare, finance, energy, etc., etc. You diversify across numerous sectors. You also look at market capitalization. Market capitalization, you may diversify across stocks with from different market caps. So it includes stocks from different of different sizes, such as large cap, mid cap, as well as some small cap stocks. So you may diversify based on the market cap. Market cap simply means the share outstanding of the company multiplied by the current stock price. That will give you the market capitalization of the company in question. You may equally incorporate geographic diversification. Geographic diversification. So incorporate domestic and international stocks for broader exposure. That is, when you diversify away from your home country. Not only that, we have style diversification. Style diversification. In this case, you may balance growth stocks, value stocks, dividend paying stocks, to capture different investment styles. These are all different approaches. You can adopt these styles together in a single portfolio to guarantee you a decent level of diversification when it comes to style. And you may equally use ETFs and mutual funds. You can make use of ETF, that's exchange traded funds, as well as mutual funds to diversify. So this provides instant diversification by offering exposure to a basket of stocks across many sectors and across different regions. Let's look at the limitation of diversification. The limitation of diversification. There's systemic risk. Systemic risk. And diversification cannot eliminate market-wide risk, such as economic recessions or global crisis. Like a typical example is the COVID-19 pandemic. It's an industry-wide, it's a market-wide risk that diversification cannot tackle, cannot handle. But it could equally be handled because at that time discovered that retail companies like Amazon still did pretty well. Companies like Zoom, assuming you diversified into Zoom stock, into Zoom and Amazon, you could probably have done better, But all the same, it has limitation when it comes to systemic risk. There's this issue of diminishing returns. Diminishing returns. So over diversification can dilute returns, as excessive holdings may reduce the portfolio's ability to capitalize on high performing stocks. So you discover that the more you diversify, the more secure you are, but the lesser the returns. It gets to a point where over diversification sets in, and that will start affecting your return because you are diversified away from high performing stocks or assets. So in conclusion, diversification plays a critical role in reducing risk in a stock portfolio by spreading investment across different assets different sectors, and as well as some different geographies. So once you are fully and adequately diversified, discover that you have a stable portfolio that will give you stable returns over time.